guys, welcome back to Yon Yield. We want to look at something interesting here that I found for you guys. So what I found for you guys is actually the interest rate of the US, right? And we want to see how that actually changed, what happened when the interest rates were higher and when they were lower, because we want to see now the Federal Reserve potentially on Wednesday is doing the first rate cut, right? Probably 0.25 basis point. We will see. And our question is basically, is this good for the stock market or is it not so good, right? So we want to jump into that and explore that a little bit. So without further ado, let's change here quickly the screen. I have prepared for you the following. This is here from Trading Economics, right? So what you guys can see here basically are the interest rates. And we want to see, because actually everybody kind of has this idea, oh, low interest rates is good for the stock markets, then the stock markets will go up, free money, right? Free money, everything will go up and forever. However, is that true though? Because have a look here. Normally, the problem is when we increase interest rates, you can see this here. Maybe you can zoom in here somehow, probably not, but let's have a look here, right? This is 2004, right? So here you can see the Fed decided after a period of low interest rate to, you know, as an answer to the 2001 crash or 2000.com bubble, right? That basically happened here, 2000 to 2001, right? So to combat that, they had these low interest rates of 1%. And what happens normally in this kind of low interest rate environment, it's basically a big moral hazard, right? Because there's basically no risk to borrow money because it's basically free money, right? And then you just put this free money in some kind of risky investments, right? And if they don't work out, well, basically you're just gonna borrow more money, right? So that's basically what's going on here. So it creates all kind of problems and moral hazard, in my opinion, and it's actually not that good, right? So but as you can see, so we had this kind of moral hazard period right here. And what happened actually because of these low interest rates? Basically, it created a huge moral hazard in the terms of that all of these kind of mortgages were giving out to people, right? And then they created, of course, these new financial products called mortgage-backed securities, right? Where they kind of bundled them into, like they took maybe hundreds of them, bundled them into one product, and nobody knew what was inside. You know, nobody knew if these mortgages would get paid back, if they're AAA rating mortgages or if they're like bad mortgages in there. Of course, the rating agencies, they were also making money in this environment, just giving out good ratings, but nobody really understood what was inside this bundle of mortgages, right? And this kind of stuff happens in this kind of low interest rate environments, right? And so basically then what happened is in 2004, right? In 2005, the interest rates, they went up, right? And this is what caused then the problem of the crash, right? Because the problem is a lot of these mortgages, they were variable interest rates. So suddenly they were a lot higher and they were giving out to people who, basically could only pay them off if house prices would, still increase, right? But of course, if the interest rates go up, they have to pay more interest rate payments. And that is a problem if the prices of the houses don't go up in the same pace, right? So basically, this is what happened here. And then eventually, the interest rates were so high here at 5 or 5.25% that this was not sustainable. It stayed like that for only 1 year or something, and then basically this whole bubble popped, right? And then of course the Fed actually the Federal Reserve has the data that's closest to the crime scene, I guess. So basically they already, before this happened, started to decrease the interest rates, but it was already too late, right? So they decreased it right here, but then in 2008 we were finally in this crash. So we can see this here in the Dow Jones. Unfortunately, I cannot check this out on the S&P 500 because I don't have any kind of data that goes back that a long time ago. Basically, you can see here, this is the kind of bubble, right? And then here is the ABS, so asset-backed securities bubble, right here in 2008. And this kind of started, when when was the top, right? This is the important question. Well, the top was basically in the end of 2007, right? So a lot of times you see these kind of transitions into a crash or bear market or whatever, with when a year is completed, So 2007 was still okay, but then here you can see it November, December 2007, it was already topping. And then basically in the beginning of the next year, here we were still at the same levels, right? But the really washout move here happened here with this red candle here on the monthly. This is a monthly chart, guys. So this happened here, what was it? This was in May 2008, right? And basically then here in June 2008, this was the momentum candle, where it was pretty certain after that there is probably something bad going on. These button and trading views never work. So this one is the momentum candle, right? And this one also shows you there is more downside to come, right? So if you measure out this candle, you would expect these prices down here, and this was a pretty violent crash, so it even went to like 400 extension, right? So that means just this candle 4 times stacked on top, or stacked to the downside, basically, right here. So yeah, with that being said, basically it topped out end of the year 07, and the signal basically really started to come through in the summer 2008, right? This is when it went down. So now let's look here. Basically, the Fed started to decrease the interest rates in exactly end of 2007, kind of like last quarter, right? The last quarter. So September, this is actually where we are now. We're also now in September again. And again, we are, as you can see right now, at the same kind of level, 5.5% right now. And again, the Fed wants to now decrease it, right? And this is the so-called soft landing, right? Except it's never soft, I guess, because you need to think a lot of shit piled up in this low interest rate environment, where you just create this huge moral hazard, and companies, rich people, of course, will take advantage of this. If you get free money, if you're on top, right? If you have a big company where you can actually get access to these very low interest rates, and basically they're for free, then of course you're just going to borrow money, put it in some risky investments, try to sell off that risk as well as you can, if you can, with these kind of new products that you then create, put some names on it, right, to make it sound all sophisticated. This is what the financial industry always does. And if it still blows up in your face, well, then you just get a new loan to cover the old one, right? Because anyway, interest rates are zero, right? It's free money. So and taking out loans is of course good as a company, because it looks like you are in debt, and then you don't pay any taxes for that year, right? So this is basically what's going on. This is also why, for example, Apple, who has the most cash of all companies, just takes on debt the whole time, because it's for free, and then they don't need to pay taxes, or they can reduce their tax burdens. And then of course they do some kind of shady tricks with going to Ireland or whatever. What is the name? The Irish Dutch sandwich, something like that. I forgot what it was, but it sounded disgusting. Yeah, and the question of course is then, okay, if this is true, if there is no soft landing because the Fed will screw it up again, because there's just too many moral hazards that have happened, there's too much stuff that built up in this very long low interest rate environment, which I think will be the case. The question is then, where is the new bubble? Which industry will pop, right? Because in the past, it used to be, like I said, the housing markets. It was real estate with the mortgage-backed securities that were all bundled in these fancy products. I even forgot the name of them, but I studied all of this. Subprime, whatever it was, right? And basically the new bubble, in my opinion, this is only my opinion, I don't have a crystal ball, but it is in the private equity, right? So here I have one article. Actually there's another one in Bloomberg, but the Bloomberg one, you need to pay for it, but I think this one here is similar. It's also by the Bloomberg. It's actually also relying on the one from the Bloomberg News, right? So basically, what is private equity? If you don't know, if you have never heard about it, there are a bunch of YouTube videos that are very well. Go look them up. Private equity is actually one of the most cruel businesses, in my opinion. They're kind of this phenomenon that I would classify as, in German, Raubtierkapitalismus. In English, we could say predatory capitalism, right? So basically, private equity is this magic trick where you can borrow a lot of money because the interest rates are zero, right? So there is no risk, and any company can borrow money. It doesn't matter if this company is about to go bankrupt. It doesn't matter, because everybody wants to give you money because it's anyway for free, right? So so the lenders, they want to give you as much money as they can. So it is like a boring paradise, right? And everybody wants to give out loans to, like, to these risky like companies to turn some profit, right? And they even must, because because interest rate is so low, right? So you must, even if you want to turn a profit in this perspective of a lender, you want to make a profit, so you need to go into risky things, right? So basically in this environment, what happens, you have this private equity stuff, and what they do is a private equity firm is looking at another company which is not very in a good health or good state, right? And they make a deal with this company, right? They basically take over this company, but the magic trick is that the private equity company that is buying the unhealthy company, the bad company, right, is not taking out any kind of debt. They're not borrowing any money to buy this company. No, the unhealthy company that anyway is already trash, this company takes on all the debt, right? And after this deal, yes, this unhealthy company belongs to the private equity company who did that buyout. This is called a leveraged buyout, because you essentially use leverage in terms of debt, right? So the unhealthy company then belongs to the private equity company, but the magic trick is that all the debts, all the borrowed monies in the books of the unhealthy company, not the private equity company, right? So it's a bit crazy. And what happens after that? The first thing that happens is the private equity company then wants to turn a profit. They don't want to keep this company, right? Remember, in a low interest rate environment where you have all the moral hazard, what is the magic trick? The magic trick is you find shit, right? You rebundle that shit, and then you give away the risk, right? You want to sell off the risk. The private equity company is doing exactly the same. It's exactly the same as with the mortgage-backed securities all over again. How was it in the mortgage-backed security environment, right? It was, okay, you find all these mortgages, you lend out all of this money to all of these lenders who want to buy houses. It doesn't matter if they have jobs or not. And there were these ninja loans, right? No income, no job. People, you just give them the house, right? Then you have this mortgage on the book that you should collect. So on the book, it's realized profits, except it's not, because they still need to pay you. And then you bundle all of this crap and sell it off so nobody understands what's inside. Well, the private equity bubble, in my opinion, is a lot similar, because what is happening here, right? So basically, you have these trash companies. They are absolute trash. Then again, you again give them some kind of, you allow them to borrow money, which they should not do, right? It's the same, it's almost the same like the ninja loans, right? It's just on a different kind of scale, right? So you allow them to borrow money, which actually they should not be able to do, but they can do it through the private equity company, because they make us some deal, right? Oh yeah, we take over this company, we will restructure it, it will be all, super good, like all rainbows and fairies in the future, right? So basically they take it over, all nice, right? And then the private equity company, the first thing they do, they restructure the unhealthy company, right? This is what they do. Maybe we can find some other articles here. Let's have a look to make it a little bit more interesting. What else do we have? Private equity bubble pop. All right, there's another one here. So basically, yes, so they take over the unhealthy company, right? And then the first thing they want to do is restructure it, right? So they fire a lot of people. They see, normally a company that gets taken over by a private equity company is full of debt, of course, because the debt is on the book of the unhealthy company, not the private equity. And the private equity management is then, restructuring it in a way that there are a lot of job cuts, right? They need to make it more slim, and the quality of the product, whatever this unhealthy company is producing, goes down, right? Because they don't care, right? They don't care if it has the same quality or not. So the unhealthy company after that produces just shit, right? So this is why private equity is so garbage. It's like a predatory capitalism, right? So basically, the company that is taken over, the unhealthy one, on the paper becomes more healthy because it's more slim. You let a lot of people go, right? You restructure, but in the reality, the quality they sell goes down because you've just fired a lot of people. They just sell trash, right? And then what happens? The unhealthy company actually becomes more unhealthy, not better. But on the book, it becomes more slim. And then what they do? They sell off this company. That is the whole reason behind the private equity leverage buyout, right? You take a trash company, you do like a quick fix, right? Put some makeup on it, whatever, so it looks good on the paper, but in reality it's actually getting more unhealthy. And then because you don't you don't fix the root problems. There's no time to do that because you want to turn a profit. So in 2 years later, 5 years later, so you want to sell this company already that you took over, the unhealthy company, right? So on the paper it looks good. Maybe there's one good year, you kind of fake the profits or whatever, and then you sell it off like to anybody who is interested in this, right? So then you make a super good profit. Why you make a profit? Because actually it's like a leverage trade. If you think about it, it's like a leverage trade, because why can you make a profit that's like 10x or whatever? The thing is, you can do that because you bought this kind of unhealthy company, but with leverage. It's like a leverage trade, right? It was not all your money, because you borrowed the money and just put it on the books of the unhealthy company, and then you give away all the risk. Just put makeup on it, give away all the risk to the whoever buys this company, and then you're done with this, and fine, you have a nice profit. So this is the private equity bubble in a nutshell. Go watch some YouTube videos if you want. I can maybe link some in the video here, because I know some very good videos about this topic. And this stuff has been on vogue, I don't know, like the last couple of 5 years especially. Yeah, I would say maybe around 2018, but it started already before, maybe 2016. Everybody's talking about private equity. This is the best business in the world. Private equity, leverage buyouts. You hear all these people in the streets working for these kind of companies, and they throw around these fancy names while sipping their cocktails, like feeling like the kings of the world. And I tell you, this reminds me a lot on the mortgage-backed security bubble that was about to pop, where all of these real estate bros work like flipping these houses or selling these houses, feeling like the kings of the world, right? Shoving these very badly structured deals down the throat of like some jobless people who just got a house out of it. It's crazy, right? And this bubble is absolutely about to pop, in my opinion, and it's about to pop due to the Federal Reserve increasing the interest rates, right? So let's go back to that chart. So let's go back here to trading economics, right? We come in here, we look at the United States, right? And then we want to look at the interest rate, which is hovering currently around 5.5, which you can see here, but where we should expect a rate cut, right? And I'm very curious because, like I said, it's expected that there's a rate cut of 25 basis point, okay, which would be just a gradual decrease. But what about if the Fed just comes out and decreases by 50 basis points? Would that be good or bad for the market? In my opinion, it would be bad. Why would it be bad? Because it would show a clear signal that the Fed knows something, that they know there is some shit happening, and this shit is about to hit the fan, right? And in my opinion, this shit that is brewing underneath everything is this, the leverage buyout bubble. And keep in mind, the crazy thing about the leverage buyout bubble is that we know that since COVID, all of this home office environment has been happening, right? And a lot of office space is not used anymore, right? Guess what? Who is dealing with all of this unused office space as well? Of course, these kind of private equity companies, right? Of course, they're in that too. So this will be a nice one. It will be a nice one. There are also other players, of course, in this, like Blackstone, etc. But this will be a nice one. And yeah, so I'm pretty curious what will happen here. Will a soft landing happen or not? I don't know. Normally it's always safe to say stock markets go up forever and ever and ever, so I never say that stock markets go down because it's almost impossible to predict a crash. And it's so much better if you think about it. If you're an economic guru, what is the easiest thing you can say? Always say stock markets go up, because you will be right 90% of times, right? So but in this case, I need to say this is a dangerous point right here. And there is one last thing I want to show you here, guys. Let's go back to the charts. Yes, I have been trading here US 100. I did a short position today. Normally I never short indices. I will show you this later in another video. It's going pretty well, actually. All right, guys, so the 10-year minus the 2-year, let's have a look here. So this is what I wanted to show you guys. So basically here we can also see kind of the writing on the wall, right? So let's have a look here. This is the 89 crash right here. So you can see first of all, what does it mean? First of all, maybe I should explain that. So this is the yields, right? Also the interest you can get on government bonds. And normally the 10-year yield should be higher a lot than the 2-year, because of course, if you they should pay you a higher interest rate if you want to give that money away for 10 years versus 2 years, right? But however, as you can see from the formula, this should be positive, this kind of ratio in a good environment, right? In a healthy economy. The 10-year should be yield should be higher than the 2-year, right? So it should be here somewhere. But the problem is there is something wrong when it goes into negative territory. There is something wrong with the economy. And why is that? Because like the 2-year in yield just got higher, right? That means the 2-year yield is preferred than the 10-year yield, which is weird, right? This only happens in an environment where there's something off, where there is kind of fear or something, right? So normally you can see we have this normal environment up here, and normally this yield curve inversion works in a way it becomes critical once it goes under the zero line. The zero line is here, the red one, right? This is where something is not right with the economy. But even if it's in there, it doesn't really matter, right? It's gonna take some time, but then once it comes out of it, this is where the stuff hits the fan, right? So you can see this, for example, here. What do we have here? It's 2001, beginning of the year, and you know this is exactly also when the crash happened, and it went up after a period of inversion, right? Here's the inversion period, and after it came out of it, of the zero line again, right? This is where the stuff is happening. So you can see this 2008 as well, and then yeah, it came out briefly here. So this was kind of a hard signal, you know. This was already in 06, but nothing happened in 06, so this was a little difficult. And then here it came out again in 2007, right? So you can see this is 2007, so this signal was still early because the stuff really only happened, you know, in the end of 2007 and then beginning 2008. So this, it took a while. This crash only happened when it was back up here after this inversion, so it can have a lag, right? So here's Corona, of course, Rona, and what do we have here? I've never seen in my life such a steep and crazy hard inversion, right? So this means probably a lot of shit built up in the economy, a lot of moral hazard, right? And this moral hazard, I'm sure it's in the private equity bubble, because I just need to go out of my house in the street, right? I live in the banking center here, and I hear the people in the bars, and I heard so much these. There were two words you always hear. This leverage buyout stuff and some kind of acquisition merger. I'm in the acquisition merger department. I look at these people, I'm like, you are sure you work there? I don't think it can be true. So I'm not gonna say anything more, but I was just thinking, how can these people work there? I'm not sure what kind of people got hired there. Anyway, it doesn't matter. So let's change the topic. So basically, this for me is, should we call it everything bubble? No, it's not the everything bubble. In my opinion, it's the private equity bubble that is about to happen, if there is a bubble, you know. If there is a bubble, you know, it could be that I'm totally wrong, because it's almost impossible to predict a crash or bubble or whatever, right? It's almost impossible. And if this stuff happens anyway, it's going to take until 2025. There's nothing going to happen in 2024, because we know these things always lag until the next year, and now we have presidential race, so the market is blind and in a trance by the presidential race. And what happens in a presidential race? Yes, the stock market only goes up, right? So anyway, we're coming out of the inversion. So you can see it right here. So this just happened this month, guys. In September, we came out of the inversion. This is pretty crazy, and this is the biggest inversion ever. So I'm very curious what will happen. I hope it will not be too bad. Actually, I don't want to have a crash. Actually, I'm not sure, but it will not be nice. A lot of people could lose their job and stuff like that, right? So I just hope it will be kind of okay, but we will see. So this is the biggest inversion ever. Just be aware of that. I think it's the private equity bubble that is about to pop here, because this is the industry that has just been gaining like crazy, and these gains are not real. These gains are not real. How can you have an exponential growth? It just can happen if you kind of use a magic trick, you know, if you kind of scam somebody, right? And these companies, in my opinion, the private equity companies, they do something which should be illegal. It should not be allowed. There needs to be some legislation coming in to forbid this kind of predatory capitalism, right? You cannot just buy a company without any money, right? The company is in debt after it, and then you just fire everybody and you destroy whole industries like that. These private equity guys, they destroy whole industries and then they become millionaires. You know, this private equity kind of trend created a lot of millionaires, you know. So sorry, got kind of on a rant here, but I just tell you what I see from my observations, right? I might be totally wrong. I might be insulting some people that I should not insult, but this is what I think is going on here. Okay, just look at the graph. There's a parabolic growth here, which is not sustainable in my opinion, and which just works with predatory practices, right? That's it, is what is going on here in my opinion. Look at this again, it's crazy, right? This, I've never seen such a yield curve inversion. So then, yeah, looking again at the markets, they're kind of topping out here, but like I think it's, I don't know, it's impossible to say where the crash will happen or if it happens, right? And probably is anyway gonna take until the next year. But this is just a lot of stuff coming together. We have a interest rate yield, we have a yield curve inversion I've never seen in my life, kind of, and then this stuff with the Fed, right? Like I said, in the past it was like that. When they start to decrease, there was some stuff going on in the economy. They don't just decrease out of you know, because they feel like it, because they must kind of do that, because there's something bad brewing underneath, right? So let's go back to other cases, right, or other examples here, and have a closer look at this graph again. So basically the first interest rate cut came here in October 2007, right? Probably the Fed knew already there is some stuff going on in the economy which is not good. They have the insider information, right? And they probably knew already that something is bad, so they were forced to decrease here, right? And they wanted to kind of prevent this, but it was too late, right? So the stuff hit the fan and then it went down here, right? So now the question is, are we at this point actually again, right? So this is a very good you know, thought experiment. Of course, history doesn't need to repeat itself, it doesn't have to, but a lot of times it rhymes. We know that, right? History rhymes. And you can see we did have this long period of low interest rates here again. Actually, even if you factor this in, it was a very long time, and a lot of stuff potentially built up in that kind of low interest rate environment, which is now in trouble with this kind of high interest rate, right? So 5.5, and now what's going to happen? Okay, the Fed wants to reduce now because they think inflation is under control. I'm not sure if that is exactly true, but let's say it is, and they want to decrease. We will see what happens this time. Now, interestingly enough, what was the point here? They decreased pretty aggressively, right? They went from 5.25 to 4.75. So this was kind of an aggressive move here. So here actually we're trying to go softer and slower, which makes sense because inflation might still be a problem. We'll see. But now let's look into the past some more, right? Because we now saw this example of 2008 or whatever it was. Now we want to look around the 2000s, right? So again, we came from this low period of low interest rates here, like relatively low, because this kind of experiment of zero interest rates or almost zero, we have never done that before. And here we had a low interest rate environment of 3%, for which in that decade was pretty low, right? So then we went gradually up, and then we went up some more. Here was actually a little decrease here in 1998, and then again here in 2000 we were pretty high, 6.5, and then we started decreasing here again with the new year of 2001, right? We started decreasing. Now let's look back at this, because as you can see here, interestingly enough, this was a lot more choppy, right? You can see it, this was a lot more choppy. This is the 2000 crash, right? Which basically, so I didn't want that, which basically started somewhere here, right? Or maybe this move. This was a 2000 crash. Doesn't even look that dramatic to be honest, but if you see it in terms of percentages, it was, yeah, I mean 35%, right? So let's have a look here then. You can see this was a lot more choppy here. This potentially has to do with the fact that the Fed was kind of decreasing first and increasing again, right? They played around a little bit. But interestingly enough, you can see here also in 98, right? There is some kind of fast kind of crash here, like that happened in only 1 month, and it went down, you know, 16%. That is quite a lot for just 1 month. So let's have a look here, because this was in 98 of July, August, something like that. And when did this first move down happen here? So this happened a little bit later though, but again, maybe we need to think the Fed kind of played around here with interest rates, and there was kind of this move down, and here again they played around, and then here this kind of crash happens, right? So maybe there's kind of a pattern, I don't know, don't want to kind of jinx it here, but interesting, right? And here the moment when they went down a lot, this was in 2001. Here they were going down consecutively, and we can see they were probably answering this kind of crash here. When was this? This is in June 2001, July 2001. So here actually we went down in summer 01, right? And then again in 02 as well. So 2001 in the summer, and then 2002 we went down, and the Fed started decreasing here in the beginning of 2001 already, right? So they started decreasing before. So they started decreasing before, and then half a year later we kind of started the crash of the 2000s, right? Kind of. So very interesting. So then, oh, actually we can zoom in here. So then let's go back to the max here. All right, guys, and that's basically it for now. So let's go back here, and so we need to see what will happen. Like I said, a low interest rate doesn't necessarily mean stock markets will rocket. Actually, I think it's a little bit of the opposite, maybe, that each time we came from a low environment, very low interest rate environment, then built up, then we went up. We kind of plateaued for a while, maybe for a year or so, and after that we starting to decrease. Normally at that point, this kind of stuff happens, this kind of crash stuff, because the Fed is trying to get this soft landing done or something. And normally this happens, in my opinion, because the Fed already has insider information that maybe the economy is not so hot, so they want to prevent this kind of crash right beforehand and start to decrease. This, I think, is why we kind of see this pattern of high interest rates for a while, and then they see, oh my god, the economy is kind of crumbling over these high interest rates, let's kind of prematurely get it down, and but then it's already too late, right? There's no soft landing. So this is basically, I think, how you can interpret it. Of course, this is not perfect. This doesn't work all the time. But this is kind of a pattern that has shown itself in 2000s, then in the 2008, and then also maybe now we will see 2024. We still have high interest rates, but trying to get them down now here in September, October, something like that, and maybe then 2005. We have the problem of a crash. We will see. Not trying to paint a dark picture here, but just keep that in mind. And with that being said, guys, I catch you in the next one. Peace.